listen. At the lows today, the market, the NASDAQ that is, was down over 3.5% just kind of in the past 4 trading days, right? So the NASDAQ getting a little shaky here, right? And you can see some of these kind of stair-step down moves, like definitely some shakiness in regards to NASDAQ. And you got to ask yourself, what's going on here? Like, why all of a sudden, is the NASDAQ getting shaky and scared like this, right? So here's what you got to understand. Jerome Powell is speaking on Friday morning. Now, there's a lot of interesting points. A lot of times he doesn't speak in the morning. He usually speaks in the afternoon. Secondly, this is on a Friday. Doesn't usually speak on a Friday. A lot of times you'll see a Fed press conference, Jerome Powell speak on Tuesday, Wednesday, Thursday, something like that. Friday, extremely rare, okay? Additionally, to add even more craziness to this is a Jackson Hole meeting. Now, Jackson Hole meeting used to be, kind of a sleepy event. In regards to the Federal Reserve, people didn't expect much, but all that really changed in 2022 with Jerome Powell's speech in 2022, which really let folks know he was very serious about upping interest rates and really battling inflation. And that was a whole situation for the market to go through at that particular time, right? So for a multitude of reasons, people are getting a little scared about this. They're a little scared of this, what is Jerome Powell going to say? And people are looking at this and they say, there's no win in regards to the situation. Some people are very fearful because they're saying, listen, if he says, you know what, we need to start lowering interest rates, Trump's right? Guess what? Then people are going to start fearing like big inflation. You could see the 10-year pop big, which then would mean likely the stock market's actually going down. People assume, like, if Jerome Powell says, hey, you know what, we're going to lower interest rates, boom, 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 they assume, like, stock market blast off. It's very plausible that initially the 10-year could spike and the market could go down significantly. It's just, if the high-level talks from a lot of these Wall Streeters that you're not going to see really talked about out there, that's going on right now, okay? Additionally, you could say, okay, he basically says, you know what, we're looking at all the data, it doesn't show we should cut right now. I'm sure maybe eventually we'll cut, but it's not right now, right? That could lead the market to say, oh my gosh, interest rates still aren't coming, right? There's going to be even more drama with Trump and the Fed and the big fight and, what's going to happen here? Is he going to crash the economy? Oh my gosh, right? So you could look at this event and say, there's no positive outcome here. That is something to consider, right? Now, here's the bigger issue with this event being on a Friday, okay? Listen, time runs out on Friday. What is Friday? Friday's options expiration day. You have unbelievable quantities of put options and call options expiring in the billions and billions and billions and billions of dollars on Friday, okay? Now, these options are going to create a lot of volatility in the market likely on that Friday, regardless of what Jerome Powell says. But, it's very possible that if the market doesn't really like what Jerome Powell says, the market could tank heavy, given that it's an option expiration day. And you could have options expiring while simultaneously people start betting on the opposite side of whatever Jerome Powell. So let's say the market takes it as a huge negative, right? Whatever Jerome Powell's saying. Because a lot of people sometimes will fade whatever the move is, essentially. So you could have Jerome Powell come out and say, blah, 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 okay? Market goes blasting higher initially. And you could have people starting to load up on puts for next week saying the initial move is just basically a fake out rally. Additionally, you could have the market tank, and then people saying, okay, the initial move is not the right move. A lot of times it's not the right move in regards to what the Federal Reserve's doing. And so you could have people then loading up on put options for the following week saying the market's still going down next week, right? So it's going to be craziness, and that's why this is so insane, because it's taking place on a Friday. You got options expiration here. It's drama, man. It is big drama. Now, the thing you got to understand about this, you might be like, why is everybody making a big deal about this? Listen, okay, me, almost all of you guys watching this video right now, we're long-term investors, right? We sit back, we make our investments, we watch those investments go up over time. Sometimes they go down when we're in a bear market, right? Or sometimes we're just wrong on a stock and they go down. That's fine, right? And we chill out. and we listen to conference calls and we're just pretty chill. That's us. But we are a minority in the market. You have to understand that. We are not the majority. We are a minority in the market when it comes to active participants in the market, right? Passive income, passive investors that just invest in index fund, they're not active, right? We're like real active people that actually make moves, actually choose what stocks we want to buy and sell, but we're just chilling, right? Others, the majority, what they're doing is they're getting in the market, out of the market. You can listen to these Wall Streeters all the time. They're positioning in, they're positioning out, right? They're going long the market. They're going short the market, right? They're going cash. It's chaos, right? And so this event for them is a huge deal. And it has huge ramifications on what their clients think of them. If they don't position correctly, their clients might look at them and say, well, why didn't you position correctly for what Jerome Powell was going to say? And so sometimes what these Wall Streeters do is they position for everything, essentially. So then they can go to their clients, and if the meeting goes bad, market goes tanks, they can say, oh, look, we went short the market here and here, right? We were scared this was going to happen. And the client's like, oh, you're so smart, right? Or they'll go, they'll have their long positions in there and say, oh, market goes up. See, we knew it was going to go up, right? They maybe take some cash out or, cash some shares out here or there before the meeting, as obviously that's happened in the NASDAQ with selling pressure here recently. And so then their big high net worth individual comes to them and says, hey, what were you doing to prepare for that Jerome Powell whole deal there, right? We were cashing up prior to that. We were worried about that. Now we're buying it. It's just, that's the game of Wall Street. You got to understand it's a different game than we're playing. And that's why there's so much drama in the market. Now, the next important thing you have to understand here, okay? Everybody has to understand this. Listen. There is no such thing in the market anymore as the calm before the storm. Now there's the storm before the storm. So you look at an event like what's coming here with Jerome Powell press conference, right? And him getting out there and talking and what's going to happen. You could look at that and say the storm, right? So you could look at this week prior to him going out there to speak and you say this is the calm before the storm, but it's not. It's the storms. We're in the storm right now. So the people are preparing for the storm. And a lot of times what happens in the market now is when the storm actually comes, the storm already came. Essentially, it's a so backwards situation, but everybody forces a storm before you actually get to the storm. So by the time you get to the storm, it's actually nothing there anymore. Okay, so it's like you think the tornado's coming in 3 hours, but actually you're in the tornado right now, and you just don't realize it, right? And then in 3 hours from now, when you thought the tornado was coming, actually it's not a tornado anymore at that point in time, right? Because there was so much volatility between that, event and when it actually happened there. So that's what you got to understand in regards to this whole market dynamic, what's actually occurring, why the market's getting so shaky, the positioning, why Friday matters so much. I hope you guys got a lot of value out of that portion right there, okay? Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with. Alrighty, Tom Lee. Looks like he had a long night.
Chairman, he's here with us at Post 9. It's good to see you.
Great to see you, Scott.
So how about that question? I mean, it's on a couple of fronts. Like, we came in to this week, which you said was going to be the start of a pretty good rally, which it kind of looked like it was. Now what?
I think that the arguments and elements for a rally to continue are in place, because even today, with the hot PPI print, the stock market is basically flat. So we had a down open. I think investors bought that dip, Part of it is I don't think that the PPI is sending a message that inflation's soaring. There are some things to sort of cut out of that number.
Sure, I agree, and people have said that throughout much of the day, but it seems to have changed the conversation, if nothing else, about the amount of rate cut we might get in September. Is that fair?
Yes, it's very fair. That is correct. But if, as we think about the rest of this year and next year, I think that the thing that's the worst case for investors is Fed hiking. That the Fed does nothing between now and year end, I think some would actually argue that's half full because the economy can handle these higher rates. But if the Fed does 25 or 50 between now and year end, really to normalize real interest rates, that's actually positive for stocks. So I think unless this was going to bring in the odds of a hike, I think that's why markets had a muted reaction.
Well, what if they don't do anything? I mean, Steve Leisman, who's going to join us in a minute, made the argument earlier today that this changes the conversation from 25 or 50 to 25 or nothing. What happens if we go on the side of nothing? Can this market stand up under that?
Yes. I mean, because number one, and I'm sure Steve's going to talk about this, the economy doesn't seem to be suffering under the weight of these current interest rates, even though the Fed is much higher than the rest of the world on policy rates. And the second part of that is, of course, that if the Fed does 25, it's still a dovish move.
Well, it could be a hawkish cut.
I mean, to be fair, to push back against Tom Lee here, right? There's some pockets of the economy that have been severely hurt by interest rates being this high. I mean, some that come to mind would be housing, autos, things like furniture, right? Anything you got to buy on loan, those pockets have definitely been hurt. And you could even look to areas like, why did Cava's comp restaurant sales go from 20+% to 2% in a matter of a few quarters? Why did Chipotle just report negative comps? Like the last time Chipotle reported negative comps, like we got to go back to probably, peak Rona, or we got to go back to when they had the E. coli issue. Like that's the last time I could remember Chipotle having negative comps. Sweet Green just reported like a negative 7.2% comp. Like those are pretty disastrous. So, I mean, I think we got to look bigger. We got to look further than just the biggest, strongest companies in the world and say, well, the biggest, strongest companies are putting up great numbers. Those companies put up great numbers regardless. They're special for a reason. They're $1 trillion plus market caps for a reason, right? And it's not by accident. They're the most special companies in the entire world. And they put up the numbers regardless, but there's a lot of other companies that are not doing so well in this environment, right? And in terms of the higher net worth category, let's say the top 10, 20% of wealthy in the United States, right? They're doing better than ever. Crypto, Bitcoin just hit an all-time high last night. The stock market's around all-time highs. You're getting so much free money if you have money in the bank or savings accounts, treasuries, things like that. Way more money than you would have had at any point really in the past 15 to 20 years, right? Past year or two has been a great place to park money in high-yield savings accounts, treasuries. So you're getting just literally basically free money given to you like constantly, collecting 3, 4, 5% on that money, right? And so I mean, those are all factors to weigh in. And so if you're higher income, if you got more money behind you, it's the best time ever. But I think there's a lot, if you go beneath that, there's a lot of weakness, right? So, it's just something to kind of keep in mind.
And Leisman's thrown out that too, right? If they cut 25 and leave us with the feeling like, all right, you got your little lollipop here, everybody, and now we're going to wait and see.
Yeah. I think the market reaction, of course, is really how people are positioned. And we at Fundstrat, we're finding a lot of investors are positioned as if we're going to see a pickup in inflation. So to them, they were expecting a really hot PPI number, thought this was going to start a decline in stocks. And that's why I think markets didn't fall as much, because I think many people have been positioned for a sort of a hot set of PPI numbers.
So Steve Leisman, I'll just bring him in now. I mean, I can only mention him so many times without actually bringing him into the conversation. He's our senior economics correspondent. I like how you framed everything up today of how the narrative has changed. We continue to hear from Fed speakers too, including one that you spoke with earlier on our air, Musalem, Barkin also speaking within the last hour. What are we learning about what this print today really means that investors need to hang on the most, you think?
Well, Scott, there's just a split out there. The market is kind of hell-bent on the freight train of a September rate cut, and the Fed is simply certainly not a majority of speakers so far. Muslim was right down the middle. The PPI rising 0.9 for the fastest gain since the pandemic. Take out food and energy and trade, and is still pretty strong 0.6. JP Morgan writing the fact that there is upward pressure across all recent inflation reports. Basically, it's going to give Fed officials some pause, is what they say. And then Muslim sounding like one of those guys who's saying, look, I'm in the pause camp here. So it's a big deal. Scott, I want to just show you real quickly the 2-year note. Take a look at the 2-year, and you can see the push me, pull you, the tug of war going on with what's happening in the market. You see the 2-year, it declined after that inflation CPI report. Now it's back up here. Now take a look at probabilities. You can see what's happened. First of all, the 50 cut is out. And that 93 there is 93, not because there's 7 percentage points as there was yesterday to 50. There's 7 or so in the Fed pausing. October's almost gone, and so really we have one rate cut only fully priced in for this year. That's sort of the hawkish cut trade right now, that maybe not in October, and better probably not in December. That's where we're at right now when it comes to Scott, the Fed funds trade and how they're all reacting to this. I think zero or no cut is a possibility for September, but it's all going to hinge on that September data of inflation and jobs.
Yeah. Hang with us as we go back to Tom. You made the argument that this market was not just going to start this next leg of the rally this week, but it could potentially be a sizable one.
Yes.
That I think you told me we could go 6,600, if not higher, this month.
Yeah.
And this doesn't change that at all?
No, it doesn't. Last week we said the breakaway move would be S&P 65, 6,600. So I think that's still intact. I don't think that one data point is enough to change a thesis around the trajectory of inflation. And our base case remains that this is...
So if you want to know when will the market actually get legitimately scared of inflation data, and it would actually cause, let's call it a lot of fear and panic in the market, that is if CPI and PPI went over 4%. If you witness CPI and PPI go over 4%, that would get people scared, because then what would happen is rate cuts would be off the table, and then people would start talking about rate hikes again. Market would be in total freak out. So if you start to approach closer and closer to 4, we got an issue. If you go over 4, you're going to get a lot of panic in the market. So just understand that. But the question is, do we go there?
It's going to be ultimately viewed as transitory by the market.
But we have this tension that exists. Labor market looks like it's weakening, and now the inflation market looks like it's at best just kind of staying where it is, if not getting a little bit more sticky. I mean, that is a real tension that the Fed has to deal with and may ultimately have to make a decision on one side or the other. We think we know which way they'd lean, but we're not entirely clear. I'm not sure the market is either.
Yeah. Fair. Well, I guess this is the challenge for the Fed, because they're having to make a decision where there's no equilibrium, right? Because the market's tension around whether there's weakness and deviation from the job side versus inflation, it is really the Fed trying to manage expectations and keeping inflation expectations anchored. So a lot of data between now and the next meeting may not be inflation related, but it's really how the market is perceiving these inflation prints. And if we shift towards viewing it as transitory, it makes it easier for the Fed to move forward.
Steve, you have Goolsby tomorrow morning, don't you? I can almost assume that we know what he's going to say, because he's been non-committal in everything leading up to this interview tomorrow, right?
Yeah, he's one of the ones who has already said that he's not convinced it's a one-time price increase. But I do want to echo something here from the Kansas City Fed. He'll be our host next week in Jackson Hole. He said specifically that he looks around, he goes, hey, I don't see that we're so tight. He looks at the stock market, looks at the bond market. Which parts of the economy would you look at and say, okay, we could be doing a lot better here? Tom also said something that I want to make more confusing and more technical than Tom said it, which is that there's stuff happening on the equilibrium on both sides of the Fed's mandate. You tell me what the right equilibrium rate is for the employment market, given what's happening with immigration and deportation. Then tell me what the right equilibrium is for inflation, given what's happening with tariffs. Both of these things are in constant flux every day with a tweet from the president, other things going on, trying to figure it out. That's a reason I think some Fed officials would say, hey, I'm waiting to figure out what's going on here before I do anything.
I mean, with all due respect to President Schmid, I still want you to get a good room assignment in Jackson Hole, Steve. I mean, the housing market is horrible. If he wants to look at one really important place that maybe carries a lot more weight than other areas, it's terrible. And cutting rates, many believe, would help at least give a little bit of medicine to that.
Yeah, I'm not sure, Scott, that cutting interest rates wouldn't mean that the money you save on the interest rate wouldn't go right into the asking price for the home. So that's not clear to me that it's an interest rate problem as much as it's a supply problem. So I agree that lower interest rates would help some people into their home, especially the hardest hit out there, the first-time home buyers that have to struggle and stretch to get into a home. I agree with that. But right now, when you have a limited supply, what would happen was a rate cut would end up increasing the price of the home, not necessarily in a saving for the buyer. And by the way, if that's the problem, and I'm going to talk heresy here, nothing stops the Treasury, the administration, or the Congress from providing further assistance to the mortgage market if that's what they want to do. Treasury can go out and buy mortgages and drive down the rate if they think that's a problem. The Fed's trying to make a single interest rate for the entire economy. And right now, the way they see it, they're a little bit above neutral, a little bit restrictive, not 150 the way Scott Besson says. And we just had David Zervos on, one of the potential candidates for Fed chair, who said the Fed should cut 50 and they're leaving millions of jobs on the table. That's Zervos' point of view.
Yeah, Steve, thank you very much.
Steve, see, the thing you got to do here is you have to... One, the Fed needs to lower interest rate. The 10-year yield, okay? I'm looking at the 10-year yield here because that drives a lot of the loan activity you'll see out there, mortgage rates, things like that. A lot of it's driven by the 10-year Treasury, okay? And so the ideal situation would be the Fed is lowering rates, but simultaneously you have investors not being that concerned about inflation. The issue you could run into is, let's say the Federal Reserve does start to lower September, but let's say investors are very concerned that inflation is going to remain much higher, then what could transpire is a 10-year yield could actually basically go up. It could also hit like 4.5 or 4.6% or something like that, which is the opposite of what Trump wants right now, and really even the Fed wants. And the reason that could happen is if the Fed's lowering interest rates and people become, let's call it, less worried about recession, but more worried about inflation. So, I mean, that's just something to kind of factor in here, but there's a lot of moving parts, and we'll see how it all shakes out. At the end of the day, you just got to remain focused on the long term as an investor in the market, right? All this stuff is going to be like all this talk about rate cuts, this, rate cuts, that. When are they going to cut? September, December, next year, blah, blah, blah. 5 years from now, it's going to be irrelevant. It's just going to have been part on the scale, right? And so, like, you can't get all freaked out and crazy about these sorts of things because it just is what it is, right?